listen-only mode.
Good afternoon and welcome to the webinar today, the Alignment Gap, Performance Measurement and Long-Term Incentive Design. Our agenda today is introduction, a research review, excuse me, the IRC perspective, and then we'll take your questions. Just in terms of webinar logistics, all the participants are in listen-only mode, but we do encourage your questions. If you can see on your control panel, there's a question function. At the end of the presentation, you can type in your questions, or actually you can do it throughout the webinar, and type in your questions and we'll respond to those questions afterward. After the webinar today, you will receive an email with a replay of this session. The report and all other IRC reports are available at www.irc Institute, along with this PowerPoint presentation. We encourage you to share information on social media. Our Twitter handle is at IRC Research, and you can use the hashtag IRC Research. If you have any audio problems during the webinar, please contact GoToWebinar at 1-800-263-6317. Our speakers today are Mark Van Cleef, partner with Organizational Capital Partners, Steve O'Byrne, president of Shareholder Value Advisors. Both gentlemen are authors of the study, as well as John Lekumnik. He's the executive director of the Investor Responsibility Research Center Institute. Just a couple words on our speakers. Mark is the partner and chief knowledge officer. He brings more than 25 years of experience consulting worldwide for institutional investors, boards, and management. He specializes in areas such as management structure and design, organizational effectiveness, CEO, executive succession planning, CEO performance, and corporate governance issues. All of these are linked to shareholder value and sustainability issues. Steve O'Byrne is president and co-founder of Shareholder Value Advisors. I can't seem to get that out today. He's considered an expert in economic profit measurement, target setting analysis, stock option valuation, competitive compensation analysis, and other issues. He was previously head of the compensation consulting practice at Stern Stewart & Company and also at Towers Perrin. He's now the vice chair of corporate governance at the New York Society of Security Analysts, and he's a certified public accountant. John Lekumnik serves as the executive director of the IRC Institute, where he directs the research agenda for the organization in coordination with the board of directors. He's a veteran of investment issues, and he previously chaired the executive committee of the Council of Institutional Investors. He's also the author of the award-winning book, The New Capitalist: How Citizen Investors Are Reshaping the Corporate Agenda. John also served as the designated investment advisor for the New York City pension funds in the 1990s. Just a couple words about the Institute. It's a nonprofit that was established in 2005. Essentially what IRC Institute does is that it funds research, academic and practitioner at the intersection of corporate responsibility and the informational needs of investors. We sponsor an annual research award. You can download our 5-year impact report on the website. And again, all of the research is available at no charge on the website. Here's a listing of just a couple of the Institute's recent studies. You can see it covers a wide range of issue areas, from nanotechnology to hydraulic fracking to board oversight of sustainability issues. We have other executive compensation studies, executive superstars. So please feel free to visit the website and take a look at all those. And with that, I will turn the presentation over to Mark. Mark?
Kelly, thank you very much. Just as a little bit of background, we ended up bringing together a number of databases that have probably never been brought together before. Both our database and the database that Steve has, Shareholder Value Advisors, both have feeds coming in from CompuStat, and we then make normalization adjustments to be able to calculate return on capital, economic profit, and future value for the S&P 1500, and so we were able to do analysis across that whole data set. The additional database that we brought in was Incentive Lab's database on incentive design. So unlike our databases, which had performance information, the Incentive Lab database has details around exactly how these plans are designed, their metrics, their performance periods. And then the last database we brought in, which we won't be talking about today, is the Fund Votes database, where we actually looked at the voting results relative to economic profit and return on capital and shareholder return. So for the first time, as part of the research project, we were bringing together these multiple databases and looking at economics and performance and long-term incentive design and how they're aligned or may not be aligned. The next slide, Kelly. So just at a high level, we walk you through in terms of some of the key highlights, one of the interesting findings, and Steve's going to take in a little more detail on this, is really the fact that only 12% of CEO pay variance is really, based on the analysis, explained by economic and operating performance. So return on capital, economic profit, which we'll explain a little bit more detail what that is if you're not familiar, and relative total shareholder return. So with only 12% being explained, raises a number of interesting questions around current pay and pay for performance design. What it does flag is that the competitive pay today is really more the dominant executive compensation paradigm and not really pay for performance or pay for value creation. The next highlight on the next slide on page 9, it's really around performance measurement itself. And so the key highlight here, which was somewhat surprising to all of us, was that we understand that the balance sheet's important and capital's important, but to discover that 75% of the 1,200 companies that were looked at in the S&P 1500 had no balance sheet or capital efficiency metrics that were disclosed and are tied into long-term incentive design raised an interesting yellow or red flag in terms of, are they really designed for long-term value creation? The other key highlight is the fact that more than 85% of companies had no line of sight metrics to future value. And we'll get into a little bit more detail about what future value is, but think about it in terms of the discounted cash flows of the expectation of growth and innovation that's built into the valuation of the company. And Steve will get into that in a little bit more detail. But the key point is that innovation is a key component to that, and 85% of the companies had no operating direct metrics that was tied to that. And then lastly, it was really the issue, again, a highlight, that only 10% of companies had a longest performance period for their executives at 3 years or greater, or 90% at 3 years or less. So that raises an interesting design set of questions in terms of designing for long-term value. On the next slide, one of the other highlights that came out of this is the fact that total shareholder return or relative total shareholder return, and there's a difference, as many of you know, are not direct measures of operating performance and management performance. Some 55 to 60% of total shareholder return is actually impacted by industry and market factors, which are all beyond the control of management. So to interpret total shareholder return or relative total shareholder return, we use return on invested capital and economic profit growth as a way to assess the operating performance. To our surprise, only 35% of companies over the last 5 years, 2008 to 2012, actually had a positive total shareholder return relative, and also had a positive return on capital greater than their cost of capital, and thus generated a positive economic profit. More importantly, 47.6% of the S&P 1500 over the last 5 years did not meet the test of generating a return on capital greater than their cost of capital. And thus their cumulative economic profit over that 5-year period was negative, which really should be a concern for all stakeholders. And the other point that came out of the research as we were knitting it all together is the instability in the long-term incentive plan designs, with their metrics and their peer groups changing at quite a high rate, both in terms of 60% of companies changing their performance measures and some 33% of companies changing their peer groups. The concern here is that that may tend to generate more of a short-term focus unintentionally. So those are some of the key highlights, and I'm going to turn it over to Steve at this point, and he's going to talk us a little bit more detail around the analysis as it related to explaining executive and specifically CEO pay variance. Steve?
Yes, thanks, Mark. This page summarizes a study of CEO pay across 12,000 five-year periods ending in the years 2003 to 2012. The study is done using realizable pay, which means that equity compensation is marked to market at the end of each five-year period. And with that methodology, we'd expect to see a lot of correlation of pay and performance. Now, our first finding is that 44% of the variation in pay is explained by size and industry. Now, that's not surprising, but given that, we might expect performance to account for all of the remaining variation in pay, the remaining 56%, but in fact, it only accounts for 12%. So one way to think of that is that of the variation in pay that's not due to size and industry, performance could explain 100%, but only explains about 20. Now, why is that? Why doesn't performance explain more of the variation in pay? One important factor is differences in target pay levels. You can see from the table that that the CEO pay level prior to the start of the five-year period, that explains 19% of the variation in pay by itself. So differences in target pay level are a very significant factor. The second very significant factor is the widespread acceptance of the concept that everyone's entitled to 50th percentile target pay regardless of past performance. Because if you think about that, if you recalibrate to 50th percentile pay within each five-year period, that's going to undermine pay for performance because a poor performer is going to get more shares along the way as a result of their low stock price, so that when the stock price rebounds, they're going to end up making a lot more money than peers with steadier performance. A third factor is the lack of consistent pay sensitivity that's related to the really churn in design that Mark was just talking about, and then finally paying for industry performance. Back to you, Mark.
Great. So let's go a little bit deeper into the key findings around performance measurement. As you probably we can see, in managing invested capital and managing the balance sheet is a critical and key role of executive management. Yet we were surprised to discover that about 75% of the S&P 1500 actually had no disclosed metrics and no disclosed long-term incentive plan design that would really align to that accountability. I think it could be fair to say that generating a return on capital greater than the cost of capital is a key objective of management, and thus being able to generate what is positive economic profit, and we'll explain in a couple minutes, if you're not familiar with economic profit, what really that is. But being able to generate a positive return on capital is pretty critical. Yet when we take a look at the measures being used today that at least are being disclosed, less than 17% actually are using a return on capital or economic profit type of metric in the incentive design. So that's, again, a very, very small group. And so there's a large group of companies that in terms of measuring capital efficiency and effectiveness and how well management is doing and doing that and really creating value, that's not at least part of current disclosures or part of long-term incentive design. I think equally important is this concept of future value that I alluded to a couple of minutes ago, and Steve will go in a little bit more in detail in a couple of seconds. But the key point here is that there is an expectation for growth and innovation beyond current operations, beyond current cash flows, and beyond current invested capital. Yet 85% of the companies that we reviewed out of that 1,200 company data set had no line of sight metrics linked to research and development, linked to innovation, linked to future capital expenditure design, the investments that would, really kind of link to that value. So that seemed to be a strategic future disconnect linked to current valuation of the firm. And then lastly, really kind of linked to that idea of the future is the fact that only 10% of companies have their longest performance period for the executives at 3 years or greater. And so that raises, again, some questions when we think about this. The key points here is that much of the current metrics and much of the current long-term incentive plan designs seem to be very much more short-term, current operations focused, on income statement focused, and less so on long-term true, kind of value creation. I'm going to turn it back over to Steve to kind of set some fundamentals around kind of how to think about value creation and the core fundamentals of finance that we used in the analysis that helped to provide this background. Steve?
Yes, thanks, Mark. I'd like to take a couple of minutes and explain the analytical framework that leads us to focus on economic profit and future value. Our starting point is the concept of discounted cash flow valuation, which is really one of the fundamental principles of modern finance. Perhaps the simplest illustration of discounted cash flow valuation is the value of a bond, where we say the value of the bond is the present value of the future interest and principal payments discounted at a competitive rate of interest. When we apply that to a company, we really think of market enterprise value, really the sum of the market value of equity plus debt, as the present value of future free cash flow discounted at the weighted average cost of debt and equity. And from discounted cash flow valuation principles in math, we can show that market value has two components, what we call current value and future value. And we'll show that current value is the sum of current book capital plus the value of current economic profit, and we'll say more about economic profit on our next slide. And then future value is the premium that investors are willing to pay above the current value. And one of the things we can show is that future value is equal to the present value of expected economic profit improvement, so that both current value and future value relate to the critical concept of economic profit. We can also show that returns really can be broken into two components, a current value component and a future value component, and the math on that is in the appendix of the report on page 67. Let's now turn to the next slide and talk about the concept of economic profit. And the top part of this chart is really conventional profit measures, and it's really the bottom part of the chart that's really what makes economic profit distinctive. Because you can see in the bottom part of the chart, we're taking invested capital, we're multiplying by the weighted average cost of capital to get a capital charge, and then we're subtracting that from net operating profit after tax to get our economic profit. So we're putting in a charge for all of the capital invested in the business, both debt and equity. Now, conventional profit is really a half-baked concept because it deducts the cost of debt but ignores the cost of equity. And when you ignore the cost of equity, it's easy to think that you're doing well when you're really doing poorly. The fundamental concept of economic profit is really the notion that profit or NOPAT should be greater than the capital charge. And another way to put that is to say that our return on invested capital needs to be greater than our cost of capital. So that that's the fundamental principle of economic profit. Now, if you look down lower on the slide, you can see that current value is the present value of economic profit plus invested capital. So that's one of the two basic components we were talking about on the last slide. Now, when you're earning more than your cost of capital, you can grow current value by investing more capital. So that in that situation, growth is good and adds value. But if you're earning less than your cost of capital, you're actually reducing current value by growing the business. So that downsizing is the right strategy for a negative economic profit company, unless you have good reason to believe that something is going to change that will make you a positive economic profit company in the future when you're a negative economic profit company now. And that's really a very critical question for directors and investors to answer. A strategy for a negative EP company really needs to be a plan to make it into a positive economic profit company. And that could be something like scale that's going to give you greater capital efficiency, or a great new product that's going to let you charge higher prices. If investors think that's what the future holds, they're going to bid up your future value, and that can offset a decline in current value. So that's actually why we need to bring in the second component, namely future value. Okay? And if we turn to our next slide, we can see that the second key component of value is future value, which is the present value of expected economic profit growth. And where that comes from is from investment. If you have a return on capital that's greater than your cost of capital, it also can come from innovation, new products, R&D that may be occurring when you have a negative economic profit. And so this is a very critical thing, and the trade-off between current and future value to increase total value is really sort of a fundamental thing for investors and directors. Now, future value accounts for 25 to 75% of enterprise value, so it's very significant. And yet, we find that 85% of companies don't have in their incentive plans direct measures of these drivers of future value. So that is a very significant finding of our study. Now let's take a look at one more page that shows you the impact of various factors on 5-year investor returns. And this page has two important points that we should take account of. The first is that economic profit, in other words, looking at both profit and economic profit change, tells us more than just looking at conventional accounting metrics of net income and net income change. That when we bring in the capital charge, and we explain 43% of the variation in 5-year returns versus 38% when we're just using conventional accounting measures. But the second very important point of the chart is that when we look at the easily measured drivers of future value, namely having a high return on capital, having growth, and the interaction of growth and high returns, those explain some of the variation in returns, but they still bring us up only to 48% of the variation explained, so that we end up having 50% or 52% of the variation that is captured by those hard-to-measure drivers of future value, as well as by market and industry factors. So let me turn it back to Mark, and we'll continue.
So picking up on Steve's point, a critical part of the value and valuation is this idea of future value around investors' expectation for growth and innovation from new products, new markets, new business models, and the cash flows that would come from those future activities that would be created. But what was interesting in the analysis that we did is we discovered a 45% decline in research and development and capital expenditures as a percentage of revenues over the last 12 to 15 years. And this suggests that there may be more of a short-term focus in companies. We're not exactly sure. But the key point here is that this is for all the median of the S&P 1500. And the key point is this decline in the investment to create this level of future value that's required. Now, this type of decline might make sense for a late-stage company that's maybe in a harvest mode, but it wouldn't make sense for the entire S&P 1500, which is what this chart is mapping out. So this is a bit of a cause for concern in terms of both the performance measures that are being used as well as the long-term incentive plans that are being designed and approved. Is possibly, are they too short-term focused and are they too operationally focused and not really incenting executive management to really focus on creating mid to longer term value. It's similar to the problem or the challenge with earnings or earnings per share because earnings per share could be going up as a result of share buybacks and other execution, but that doesn't necessarily mean that long-term strategy, long-term value is being created. So this was just a concerning trend that popped out of the research that links back to this future value concept that Steve had talked about as one of the two key components of creating long-term value. And if we look at the next slide, again, going deeper into some of the economic findings as we ran the analysis on the entire S&P 1500, shareholder return or relative shareholder return are problematic measures because some 50 to 60% of the movement in share price are determined by industry and capital market factors that are all beyond the control of executive management. So if we start by looking at value creation fundamentals, like is the company providing a return on capital greater than its cost of capital, and did management actually grow positive economic profit over time, all stakeholders get a much more strategically insightful assessment of executive management and their performance and their leadership quality beyond what you would get just by solely looking at TSR or relative TSR. So it really provides us by providing an overlay or a foundational start by using return on capital relative to cost of capital. And by looking at is management actually growing economic profit, it actually gives a much more insightful way to interpret any analysis of the relative total shareholder return. What was interesting here was that in the long run, a company can't have a return on capital less than its cost of capital, i.e. negative economic profit, and create positive shareholder value. Yet at the same time in the last 5 years, that 08 to 012 time period, and it was pretty consistent over the 10-year period as well, we actually discovered that some 47.6% of companies generated a negative economic profit. So that really requires a deeper dive to take a look at, a little further about the interpretation. So in the next slide, you'll actually see as we take a look here, on the top axis is relative total shareholder return, positive and negative. On the vertical axis is the return on capital or cumulative economic profit over 5 years, again over that same time period. And what we really start to discover here is that a one-size-fits-all approach to using total shareholder return or relative total shareholder return doesn't really work because of the measurement problems that I alluded to before about what TSR is really measuring or purports to measure, but actually in really assessing management's contribution to creating enterprise value and shareholder return. So by adding this overlay of economic operating performance to the mix, starting with the question of is return on capital greater than the cost of capital, and is management generating a positive or negative cumulative economic profit, we get a much greater insight into how to interpret any of those TSR numbers. So as an example, in the bottom right-hand quadrant, I'll call that quadrant 1, we actually see that 17.3% of the companies had a positive shareholder return over 5 years, yet they had a negative 5-year return on capital, and their total cumulative economic profit was also negative. So what this really raises a question, really, to what Steve alluded to, is there a clear strategy to get to positive return on capital? That needs to be a fundamental question that management's asking, the board's asking, and shareholders should be asking. And it's really all about the future value, because that's why that positive shareholder return, relative shareholder return is there. It's somewhat reflecting that. The upper left-hand quadrant is a reverse, where there's negative relative total shareholder return, and in the analysis we did, it was to the GICS peer group, the 4-digit level. But it was also the fact that these companies are generating positive returns on capital and positive 5-year cumulative economic profit. So the real question there is, it seems to be, it's not about the current business. The current business is doing exceedingly well. For those 17.9% of the companies, it's really about, is this really in a harvest mode, or is there a real expectation for growth and innovation? Because right now the capital markets are not interpreting that there's really a lot of growth in here. So between that upper left and that bottom right, those two quadrants, we've got 35% of the companies where total shareholder return as a measure is in conflict with, in essence, the economic fundamentals, and looking at return on capital and how it gets interpreted. So the key point here is really around the issue that we have to get beyond just using total shareholder return as a number, an interpretive number of what it really tells us, and without the underlying economic indicators, we would be suggesting return on capital and economic profit. It's really, you can't really interpret the TSR numbers and the fundamentals of the business that well. So having set the stage on the performance piece, pardon me, let me turn now to the issue of long-term incentive plan design. In working with our colleagues at Incentive Lab, they pulled a broad range of numbers of how some 1,200 companies had been designed and what those designs look like. And we'd mentioned some of the problems with total shareholder return as a measure of supposed management performance. But TSR also has challenges in its bias because of the choice of the beginning and the ending point, and also it's impacted on a relative basis by choice of the peer group. Yet we discovered that over 50% of long-term incentive plan designs are using TSR in one fashion or another as a performance measure, even though there are a lot of challenges in, is it really measuring management's performance? Steve had alluded to the fact that earnings and earnings growth actually has a reasonably small correlation or smaller correlation with long-term shareholder returns. And that's because it doesn't really take into account the level of invested capital, the return on capital, and the future value that's coming from potentially expectation in new products and new markets. And so again, EPS, again with possible challenges of share buybacks, yet today we're looking at the fact that it is probably around 48 to 50% use and frequency in these long-term incentive plans. So the two most frequently used measures, total shareholder return, earnings per share, earnings per share. The two most frequently used measures don't really have direct line of sight to the underlying drivers of value creation, which the core finance fundamentals would point to, being return on capital greater than the cost of capital and growing economic profit over time. So that's kind of a snapshot of that disconnect. On the next slide, back to the future value piece, is really this issue around innovation. And with innovation, research and development, and future capital expenditures, that's really what drives the growth in future economic profits and being able to maintain a high return on capital greater than the cost of capital. In most industry sectors, technology, pharmaceutical, industrial, oil and gas, mining. The innovation cycle generally is a 3 to 7 year or longer cycle between R&D and commercialization and then bringing that into capital expenditures. Yet here we find through the analysis from Incentive Lab that the longest accountable performance period for 90% of the 1,200 companies in their database, which is the bulk of the S&P 500 and 400, is in essence a strategic disconnect in terms of this future value piece that was one of the two core key components to the drivers of long-term value within companies. And the last key finding on the next slide really was a bit of a surprise, and that was the amount of change and churn we're seeing in these long-term metrics and these long-term designs. With close to 60% of companies changing their metrics each year, both short and long-term metrics, and with some 33% of companies changing 25% or more of their peer group, this level of change in measures in peer group may tend to foster, again, more of a short-term focus per the previous slide. So again, these are some of the challenges we're seeing that are suggesting that there may not be the level of long-term value creation alignment that's really linked to kind of the long-term drivers. So are there companies out there that are doing a better job or really more exemplar companies? And there are. And we would point you to two in particular. One would be 3M Corporation, and one would be Abbott Labs. These are companies that, if you look at their performance over the last 5 to 7 years, they've got sustained performance in revenue and economic profit growth. They have high returns on capital, and they have significantly above median relative total shareholder returns. You'll also see in what they've disclosed is that they're using balance sheet and capital efficiency metrics, and they're in many cases using return on capital and economic profit in the case of 3M. And in the case of 3M as well, they literally have in the long-term incentive plan an innovation vitality index measure, which is measuring the growth and profit to come and has resulted from new products and new revenues from those new products and new markets over the last 5 years. Abbott Labs similarly has measures around their product innovation pipeline. So again, they have that as a key part of what they're measuring. So really, as we think about on the next slide, really what the research is pointing to, it's bringing up a number of questions for investors, boards, and executive management. Are they measuring capital efficiency, and do they have balance sheet metrics to really measure, or are they really creating value? And ideally, are they probably linking it to return on capital greater than the cost of capital and growing economic profit over time? So again, 75% of companies had no capital efficiency or balance sheet metrics. That's a question of where there may be an opportunity to kind of close that value creation gap. Then there's the question of are we driving with the right future value measures around growth and innovation and around research and development? And is that a line of sight that can be created for management so it's really clear for all everybody inside the company as well as external stakeholders, investors, et cetera, that the company, like 3M and like Abbott Labs, really recognizes that a core to long-term sustainability of returns on capital really is innovation. And then being able to recognize that you can't do breakthrough innovation in 2 to 3 years. In many of the industries, the innovation cycle is really 3, 4, 5, 6 years of cycle. Yet today, we've got 90% of our executives, the longest performance period they're measured on is 3 years or less. So really, and then lastly, the stability, or second last, the stability of the metrics, the stability of the peer groups, and then is that creating a misalignment as we're seeing at least in the analysis. And then, back to Steve's opening point around pay and performance, we have such a small variation to explain it. There is an opportunity to explain more, but it would take the requirement to have better designs and better performance measures that really link to the long-term drivers as we've outlined in kind of the core finance and fundamentals today. So these are some of the questions that we think some of the research raises for the stakeholders of the investors, the boards, and executive management. John, I think you were going to make a couple comments from an IRRC point of view as to how you were interpreting and seeing the results of some of our research and analysis.
Yes, I was. Thank you, Mark. First, I just want to take a moment to thank Mark and Steve. I thought that was a wonderful explanation of I don't want to say it's dense because it's not, but a very nuanced and researched report that, as Mark said, drew upon multiple databases that had never been combined before. And I would encourage you all to read the report because there are really 5 or 6 headlines that come out of this. One is the pay for performance misalignment. One is whether or not boards are giving clear incentives, things that management can control as targets in long-term compensation plan. One is, as Mark said, the time frame. One is the lack of economic profitability metrics, and one for incentives and also for performance measures. So there's a lot that's going on in this report, and I would encourage you to read the report. There will also be a second report that we are desperately trying to get out before the end of the year about how investors vote, taking these or not taking these issues into account. That being said, I think I have been a governance and investor, an institutional investor person for more than a quarter century now, and sometimes we have to go back to primary purposes and ask what is it that investors really want. The idea of alignment came out, actually steps back to what before Bill Clinton was president, and has a lot of twists and turns along the way. But we wanted an alignment. We wanted everyone to try and get wealthy together. We did not want executives to get paid when investors weren't getting paid. But there was an underlying assumption there, which is that the corporation would be run to create real value over time. Over the last 25 years, in effect, alignment, which is a post hoc measure, TSR is a post hoc measure of the co-movement of stock price or total return, including dividends, and compensation has come to become the primary measurement. And it's in these plans which are ex ante, which is a little strange because alignment itself is not what anyone wants. The example here is a 9% drop in total shareholder return, and a 9% drop in executive compensation is perfect alignment. And believe me, neither the CEO nor the other named officers nor the board nor the investors are going to be happy with that. And yet it's perfect alignment. So the condition necessary for alignment to be even a secondary measure is really value creation. And somehow along the way, we have lost the focus on value creation as the primary and dominant incentive, and we have gone to a ex post measure which cannot be managed to as the leading incentive metric. That doesn't seem to make sense. So shouldn't we focus on value creation? And I think that Steve and Mark have shown the way here, which is use multiple measures, include a capital efficiency metric, use metrics that drive innovation, new product, new markets, in other words, the drivers of future value that they both spoke so much about, and use a clear line of sight. You can't, I mean, if TSR, and even to some extent relative TSR, are driven by Fed policy and whether or not Russia invades the Ukraine, those are not things that management can control. Let's use some line of sight metrics that they can. Next slide, please, Kelly. So the second aspect of that is let's use the right metrics. Let's use them over the right time period. Mark went through a lot of this. I restate it. I'm not going to read through the slide because everyone's heard it. But there are a couple of things worth emphasizing. Investment for future value creation has declined precipitously in 14 years. That's before the financial crisis, after the financial crisis. We look to see if it was related to the tech bubble. It was not. You could look at it in other sectors that are not tech related. In fact, tech still leads to some extent in making those sort of investments. The time period of 3 years Mark talked about, even more disturbing fact, 25% of the S&P 1500 don't even have 3-year long-term incentive measurement periods. They rely on time vesting equity-linked compensation, what the shareholder activists would call pay for being alive. The churn we talked about. And I think all of this adds up. It's not a coincidence that the median future value, as Mark pointed out, has declined from 50% of enterprise value to 27% of enterprise value. So it would be nice to start creating some more long-term value and future growth. Next slide, please, Kelly. That being said, this change isn't going to be easy. Over 25 years, we have all become very comfortable with TSR. It is the dominant metric, as shown. It is the dominant philosophy. There are directors, compensation consultants, investors, we're not innocent, proxy advisors, and others who say, well, yes, we know it's flawed, but it's objective, it's measurable, it's observable, and we know how to do it. Unfortunately, it's the wrong metric. And certainly it's the wrong metric as a standalone metric for all the reasons that we've discussed. And so the fact that it's observable, we're in football season. I mean, it's sort of like if you lined up CEOs and did a 40-yard dash and measured them. So in football, a 40-yard run measurement is the standard time. That's measurable. It's objective. It's observable, but it has nothing to do with value creation. And to some extent, TSR, and even relative TSR, ex ante, has very little to do with value creation. It's not a driver of future value. It is an ex post measure of stock price movement. It should be used as at best as a secondary after you've created value to see our share owners and executives and others being rewarded in a sort of equal over time basis, but as equal over time, but it is not a basis for creating a long-term incentive plan. With that, I think we will take questions. I'm sure there are lots.
Thanks, everyone. We're on to the Q&A portion of the webinar. Just as a reminder, this webinar, a replay will be posted by tomorrow at the latest. We'll also have these slides posted on the IRRC website. If you would like to ask a question, if you take a look at your control panel, there's a question box. Just type your question in there and we will read it aloud, and Mark or Steve or John or all three can respond to your questions. So I'll give it just a couple seconds. We do have one question already. What has been the reaction, if any, that you've received so far regarding the report?
John?
Sure. I'll take that. I have gotten really excellent reaction from people who have read through the report. They think it's the right level of question. I also have gotten people saying it's the right set of questions to ask, and it's going to be really hard to do anything because of this install base. So I'll give you two examples. Before this started, Mark was selected via an RFP for this project. And by the way, again, I want to thank Mark and Steve, and I forgot to mention also everyone else who worked on this report at their organizations and the others. And one of the leading executive compensation consultants called me and said, you're asking exactly the right questions. I'm not bidding on this. It'll cost me my business. But when it comes out, let's talk. And in fact, we had that talk, and he thought it was a wonderful report, exactly what should be asked. And he sort of wants to be the second into the pool. And I think I've heard that now from a number of people. Some of the leading institutional investors, on the other hand, are trying, and I've heard this from both asset owners and traditional mutual fund families, are looking at this seriously and trying to figure out how to get some sort of capital efficiency metric into their analysis.
Terrific. The next question, is this webinar CPE eligible? And I believe the answer to that is no, correct, John?
No.
Yeah.
Sorry.
The next question, why don't more firms use balance sheet metrics like EP and ROIC?
Steve, why don't you take that one?
Yeah, Kelly, I can respond to that. I think one of the biggest reasons is that growing economic profit is much more demanding than growing conventional profit, so that earning more than the cost of capital is really a high standard, and there's a lot of resistance to it because of that.
Thank you. The next question, do you think this study will have any more impact than EVA that was so big a few years back?
I can respond to that too. I think the basic concept of economic profit has been used in business going back to really the First World War, when DuPont and General Motors were using it. I think what's new in this report is really emphasizing the need to look at economic profit and future value, so that just looking at economic profit by itself really creates much too much focus on sort of short-term value maximization than true investor wealth maximization. So it's really the combination of economic profit and future value that's the critical thing, and the reason why that's a better approach than the economic profit approaches in the past.
I would add one. I don't know whether we'll have more or less. I would tell you that there are changed circumstances. We have widespread say on pay, which did not exist during the intellectual boomlet, if you will, for EVA. Excuse me, for EVA. We have a series of investors who are interested in this, and we have I think it's fair to say, a burgeoning intellectual discussion in this country around short-term, long-term value creation issues. So those are conditions that are different. Whether they are different enough, I can't predict. But in addition to the differentiated research around future value that Steve just said, I also think we have different conditions in the field in terms of the intellectual debate and the ability of investors to be heard on these issues.
John, to what extent do you think the lack of the media may be pushing, a lot of times the media will put out their annual rankings of performance, but a lot of these types of measures don't tend to be in those. Is that an area for thought leadership from the media to bring about change as well?
The media reflects what is happening. I mean, I think that if a significant investor were to say they were going publicly, they're going to consider this. If a significant proxy advisory firm, I think that as more companies think about this, you will get more media coverage of it. They are, unfortunately, it is a more complicated set of concepts than measuring stock price from point to point. That is the advantage of TSR. It's easy, it's understandable, it's observable. In terms of comprehension, it's not necessarily the right answer in terms of value creation. So I think that the media will reflect what's going on. And I do think the media has taken, is part of the intellectual discussion around short-term, long-term. So to that extent, it's setting the context as well.
Great.
We have another question related to EVA. Questions on capital efficiency metrics have come up for some years. EVA some years ago seemed to be the focus for some folks, yet little progress. Why the resistance?
But Steve, I'm going to defer to you, but my impression is a full-blown EVA implementation was very intensive and very costly. You needed, consultants and all sorts of accounting adjustments as you went through it. I think that this is a little different. This is saying what is it that you can actually manage to, what can named officers affect, and what drives value without getting lost in all the myriad of adjustments. But you're the expert on this, and I will.
Yeah, let me just add one comment to what I mentioned before, which is when you're just focused on EVA, it's very easy to discourage value enhancing growth, and the underlying reason for that is the delayed productivity of capital, which has both an economic origin, like you're building out a distribution network, as well as an origin in conventional accounting problems like straight line depreciation. And so if you're using economic profit without measures of future value, it's very easy to discourage value enhancing long-term growth. And that was a significant problem for companies that used economic profit by itself. And that's why really the two-pronged approach of focusing on economic profit and measuring future value is so critical.
Thank you. The next question, as shareholder advocates, what avenues are available to us? Do holding requirements on equity compensation offer some mitigations of short-term focus?
I mean, the answer is it depends on your holding requirement. I mean, is it till retirement? Is it past retirement, et cetera? But that still doesn't change the alignment, the incentive, right? That just, all that does is it doesn't change what's being managed to. They're still managing to stock price to the extent that they can. And as Steve pointed out, no matter what you do, 51% of that is not manageable to under any known circumstance. So there are a bunch of things one could do. Number one, you can examine what your say on pay policies do and whether or not you look at these issues. Even looking at some of them would be helpful. Number two, you can make your opinions known to any intermediaries that do such analysis on your behalf, whether they're proxy advisory services like ISS Glass Lewis or whether they are executive compensation services like Equilar. Number three, you can, in fact, if you are a shareholder that tends to engage, when you go to your engagement companies, you can say, what are your drivers of future value? How do you incent them? What are you doing? How do you take into account capital efficiency? So I think there are a number of things to do, but the first thing to do, honestly, is just to get comfortable, to see if you agree with the analysis of what drives fundamental value and the time frames. And I think that once you start thinking in those terms, it fits into the governance and engagement procedures and policies that most investors have now.
Another question that's related to our first question, have you had any reaction from the proxy voting firms?
I think we all have. So I will tell you that I have had email traffic with the two major proxy advisory firms. They are interested. They are not committing to anything. They said they would read the document and analyze and get back to us, which is, to be fair, what I think they should say. It's only been out for a week. It is fairly complicated and nuanced. Mark, I think you may have had some other conversations.
Yeah, I mean, I was just generally, I think we're encouraged that if we go back to finance fundamentals around return on capital, put aside any detailed complex EVA adjustments, but just, the fundamental concept of return on capital being greater than the cost of capital, I believe that there are, some of the major proxy advisory firms are starting to give some consideration that is material. I think they're recognizing the challenges of TSR, the gaming of TSR, relative TSR, and what it measures and what it does not. So I think to everything we talked about here, there's we're potentially at a point where I think there's a recognition that what's currently provided today for disclosed performance measurement and incentive design is not working as effectively for all members of management, board, and investors. And I think to John's earlier point, I think coming back to some of the fundamentals is important. And I see early evidence of some of the proxy advisory firms recognizing that need as well.
We have just a couple more questions. Is this the first time that the disconnect between executive compensation and shareholder value has been conclusively shown?
No, but most of the previous have measured shareholder value in terms of stock price.
Okay.
I mean, just to give some sightings, Lucian Bebchuk and Jesse Fried had a fairly well-known book, on lack of pay for performance a few years ago. In the UK, the High Pay Center, I think it is with a CNTRE, just came out with something that looked at this. But again, most of these have looked at it in terms of stock price. I think this is one of the first really robust studies that has looked at return on invested capital being greater or less than the weighted average cost of capital and on future value, and link that to compensation.
Our next question, I understand you have a say on pay study forthcoming, but doesn't say on pay voting. Thousands of companies in a short period of time cut against the kind of comp and performance analysis that needs to be done by investors.
We did a study a while ago about how investors really use proxy advisory services. So what I would say is that is a complicated question. If you're asking me, can any investor staffed, even the best of them, staffed the way they are right now, realistically do a full analysis of every vote among whether it's several hundred or several thousand companies in their portfolio? There's an obvious answer to that, which is no. In reality, that is what compensation consultants, as I mentioned before, Equilar or Mark's firm or Steve's firm, and proxy advisory services do in terms of performing a real value, which is they are staffed and they put up a flashing light to say, pay attention to this one. And the number that people pay attention to are a very small subset of the overall universe. So you can look at it on, does every investor do a comprehensive analysis of every company? Or you can say, does the say on pay vote provide an opportunity to at least capture outliers that third parties tell you that you want to do the analysis on? And the truth is both of those. Without the say on pay vote, there is no mechanism. In fact, most people when we've looked at engagement studies, find the say on pay vote useful in terms of focusing the discussion. There have been fewer no votes against board members since the say on pay vote, because there is that outlet to use.
Our next question, what do you believe the evolution of aggregated quote-unquote pay figure would be? There's so many out there, 7 versions of realizable pay, realized pay, summary comp, table pay, etc.
Kelly, do you mind repeating that question?
Sure. What do you believe the evolution of aggregated pay figure would be? There are so many out there, 7 versions of realizable pay, realized pay, summary comp table pay, etc.
I think realizable pay is the most useful, and it's also what you can call mark-to-market pay, because it's looking at a performance period, 5 years in our example, and marking compensation to market at the end of that period, which I think is a very sensible approach. I think there needs to be a lot more focus not just on the measure of pay, but how pay is related to performance, so that there's a real deficiency in measuring and quantifying the relationship of pay to performance, the sensitivity of pay to performance, and the correlation of pay and performance. And that's an even more significant issue than some of the variations in the measure side.
The next question. Oh, sorry.
Kelly, it's Mark. The other comment I'd pass along, putting on my 25 years of being in the executive search business, which I'm not active in anymore. But the reality is that if you're recruiting a senior level executive, a CEO, what really matters is what's the realizable pay. That's what's really going to impact if you're trying to attract a top executive leaving company A to come to company B. And so I think to Steve's point, the realizable, truly realizable pay is the real critical number. What would they leave behind? What do they need to be kept whole on? And what do those numbers look like? And that's much more helpful than a summary compensation table or realized pay when we're talking about attracting and retaining top executive talent.
Thank you. Our next question, do you have a sense about whether proxy advisors might incorporate these perspectives into their analyses?
I think we sort of answered that.
Right.
Mark was encouraged that they're having that conversation, and I'm encouraged that they're reading the report, but that is far from saying that they are doing this.
Yeah,
let's be fair. They do look at multiple measures. I mean, proxy advisors do have some sophisticated comp people that work for them, but in terms of the centrality of this sort of analysis, we'll wait and see.
Yeah, I think the key comment there is the proxy advisory firms. I don't know them that well, but ultimately they're customer driven. And so I think what's also important is the customers of the proxy advisory firms have to see the potential of not doing anything, and that there is a disconnect here to long-term value creation, and that by making a change, it's in everybody's best interest, both the executive management board and the investor community. But ultimately, there's a cost, as I was alluding to, the cost to do this type of analysis, to dig below the superficial look at TSR. And I think the investment community has to be willing to pay for that cost.
Just a few more questions. What changes in CEO behavior would you expect if a new metric to measure firm performance would be widely adopted?
Well, I think perhaps the biggest one would be more focus on value creation and less focus on growth for its own sake, which raises competitive pay levels but doesn't benefit investors.
Yeah, I think there would be less focus on quarterly earnings and stock price. It would still, I want to be very clear, marginally less. But I do think that when you look at a 41% drop in R&D and net new capital expenditures over the time period of this study, I would expect to see that plateauing or reversing.
Yeah, so if you look at the Wall Street Journal article that went out last weekend related to this study that happened over the weekend, they referenced, and again, it was unrelated to us and their reporting, they happened to have referenced IBM and all the share buybacks at IBM. And if you look at IBM's proxy statement, the number one measure they're focused in on is increasing earnings per share. Meanwhile, they've got a growth and innovation problem. So I think by moving away from the short-termism, by looking at true long-term value creation, that would bring about a different focus. But that's not what the system is, kind of designed to do today for too many companies.
Our next question, do you feel the SEC has a role in having companies disclose the metrics you mentioned in your presentation?
Absolutely. I think I'll give you a perfect example. It's difficult and not easy to find the longest performance period. It's difficult reading through the proxy statements to find, are there any innovation metrics being used or non-financial future value metrics being used. I think if the Securities Exchange Commission would require clear disclosures of yes or no that are binary in a way to do that, so they were HTML tagged or XBRL tagged, those disclosures would be much easier for both board management and investors to see. So I think there is a role for them to play there. It's just not been clear.
Yeah, I want to make it clear that the CDNA is supposed to describe many of the drivers of value. There is currently, obviously, Mary Jo, this is beyond the scope of the report, but Mary Jo White has said she wants to simplify reporting, and they are looking at different reporting models for everything from the financial reports to audit reports to auditor reports. So if whoever asked that question wants to advocate, feel free to. That, again, we did not look at this in the report. I want to make it clear that we didn't. But making it clear what the company is being managed to seems like a logical disclosure requirement.
Our next question, ISS focuses heavily on TSR. This could be supported on view that TSR has an ex post measure as an appropriate test for shareholders to see if the compensation plan worked. But does it lead companies just to adopt TSR as their metric managing to the test?
Sometimes one-word answers are the best. Yes. Next question.
Okay. Okay, let's see. A couple more. Do you know of any advisory firms such as GMI or ISS that will offer analysis of pay packages based on your study's methodology?
I do not. Mark, Steve? Maybe it's an opportunity for some people on the phone, a commercial opportunity for people on the phone. I don't know.
Yeah, I'm not aware that ISS and Glass Lewis are currently set up to do so.
Okay, the next question. It is my understanding arriving at the EVA measure can potentially involve several gap adjustments, not only to convert accrual-based income statement numbers into cash-based profit numbers, but also to reclassify some current expenses as balance sheet items. How can shareholders better understand these adjustments to ensure that companies are not gaming the system?
Well, there are important adjustments. For instance, in the economic profit measures for this report, we do capitalize research and development. So a small number of those adjustments can be very useful. For institutional investors, they really need to look to see how a company is doing its calculation.
One more question. How would you implement your findings in a real-world setting?
I think are you asking as an investor, as a board, as a comp consultant? I think as a board, it's pretty intuitive, not easy, but intuitive. You have a strategic retreat. You know what your drivers of future value are, and you start setting up some metrics in the comp plan that are operational metrics as well as financial. And in the financial metrics, you start accounting for capital. And at the same time, you try to understand in your strategic plan what the time frame of those returns will be, and you start aligning your time frames to it. So for a board, that seems to be an answer. Now, you always have an information asymmetry as an investor, which is how do you know you don't know everything that's going on in the board, and you don't know all the strategic planning, and you probably shouldn't for competitive disclosure reasons. But if the board is doing that, I would think that it would want to make it clear it is doing that and provide some level of disclosure in terms of the CDNA. As Mark said earlier, you can say we lengthened our longest performance measurement to 5 years, that we have added operational metrics And Mark and Steve gave a couple of examples, and you can look in their proxies and see. And I think that what you